minutes after 10. We have the New York City Controller's Office, 1 Center Street, room 530, New York, New York. Do we have roll call, trustees?
Ms. Janice M. here. Mr. Larry Schloss.
Here.
Mr. Justin Hall.
Present.
Mr. Stephen Patsy.
James Sutton, Steve Patsy.
And Mr. James Levin.
Here.
Mr. Robert Straub.
Strauss, present.
Mr. Chuck Kelly.
Present.
Mr. James McGowan.
Present.
Mr. John Dunn.
Present.
Mr. James Lamanda.
Here.
Mr. Sean O'Connor.
Here.
Commissioner Douglas White.
Here.
24 votes and a quorum within the meeting.
At this point, I think that we have to defer to the Honorable Thad McTee or Larry Schloss.
Mr. McTee will take the floor.
Okay, the Honorable Thad McTee, yeah.
Thank you, Commissioner. So, as those around the board know, that when board members leave, John Dunn is always very quick with a limerick to offer. So, while we in the Controller's Office did our best, and John is the expert, we did feel that it was appropriate to offer our limerick to John, since he's always so good about offering those to others. So we obviously wish John well, and that's the most important thing.
Is that on?
Yes.
That was the whole point, John.
Public humiliation.
It's only because we love you, John. Captain Dunn was always good with a fire, but to chief he did aspire. From the board he'll step down to be driven around, all while he waits to retire.
I had actually started a limerick in response. I only got 2 lines. There once was a trustee named John Dunn who tried to make pension investment meetings fun. I can't get any further.
Commissioner, we wrote a limerick, but it's not appropriate for public session. If any of you want to hear it, just call me up.
If I could just have a minute of personal privilege. I have to tell you, in the 7 years I've been on this committee, I think we've done great work for the Fire Pension Fund. I have the highest accolades and respect for BAM. I think you do a great job. I think you're all grossly underpaid. And, you know, you work for our members, UFA and UFOA, and we really appreciate all your good work. Larry and Barry Miller and everybody's done an excellent job. I have the highest praise. And Seema, I would officially ask that you terminate me today. Thank you.
Just, I've been on the board now for 5 years, and it was under John's leadership and the leadership of the rest of the team here. You guys really did some bold stuff in terms of investments and diversification well before the other funds really raised their hand to do so, and so showed great leadership, and I think the performance hopefully will in turn respond to that great leadership, and just congratulations.
Thank you. Appreciate it. The fund is at a new high of $8.9 billion, so it's a
This is the time to leave. This is the time to leave.
Just so you're clear, it's 9 million.
Wow. Oh, it's $9 billion.
I gave out the 8 ball, I don't have a 9 ball, so.
Well,
9
thank
billion.
you all. I've really appreciated working with you. Great professionals, and keep up the good work. Thank you.
Thank you.
Thank you.
So we'll start with the public agenda.
All right, so Martin, walk us through December.
This is for the fire pension fund. I have one extra copy. Anyone need it? So while today is the last business day of the March quarter, we're going to be talking about December in a little more detail. We talked about December last month, and in a few moments we'll be talking about January with a hint of February and March as well. But as Larry mentioned, we're over $9 billion for the overall fund. For the quarter, just to take you back, in the quarter we had the election, of course, and we had great concerns about the so-called fiscal cliff that was looming. In addition, in Europe, there was stability, and in Europe, the euro strengthened, and so for returns, it was a very good quarter. And we'll show that in a moment. And January was a very good month, and Larry will go through that after this. For the quarter, the U.S. equity markets were up a little less than 1%, but EFA developed markets were up more than 6%, primarily because of the stability that was coming across the region and the strength of the euro. Of course, you've been reading about Cyprus going on right now. So it seems like every spring now for the last 4 years, something happens. But for the December quarter, it was a very strong quarter. And so for the year, the Russell 3000 was up 15%, and non-US equity was up very strongly in double digits as well. Pardon me, let me turn this on. Sorry about that. For equities, as Seema will go through, small cap did a little bit better than large cap. Mid cap also, value did well. And in fixed income, investment grade, this is, while rates, we were talking in the last few months, rates have gone up, looking at the long rates, 10-year rates have gone up, but for the December quarter, they were still relatively in the range that they'd been before. So there's small positive returns in investment grade core fixed income, and high yield continued a very strong run as investors search for yield, and high yield was up 14% for the year. So if you turn to page 8, we have the overall numbers for the quarter and longer periods ending calendar year December 31st, 2012. The fund at the time was $8.7 billion, but as Larry represented before, we estimate we're nicely above $9 billion, and we'll come up with those numbers as we get the reports. But if you look on the left, the return for the quarter was 218, 50 basis points ahead of the adjusted policy benchmark. And fiscal year to date says 6.5%, slightly ahead of the benchmark. Larry's going to go through January, which significantly increases the fiscal year to date returns to the point that we're now in double-digit returns for fiscal year to date. And the 12 months for the calendar year of 2012 was over 13% behind the benchmark of 13.45. I want to point out that the 10-year return is over 8%. If you turn to page 10, this is a page that we went over last month, and we'll go over the January update in a few moments. The allocations were within the ranges, rebalancing ranges, with the exception of tips, and we're going to be addressing that in a little bit. January, of course, was a very strong month in U.S. equities, so we'll go through that in a moment and show you what the impact was. The next few pages show the performance attribution for the quarter, year, and 3 years. For the quarter, the 50 basis points was almost entirely due to management effect, mostly U.S. equity and some private equity. This bodes well for the private equity portfolio over the next few quarters. As you know, there's a lag. Public markets have returns, and private equity then lags. You'll see those returns show up in the next few quarters. And given the very strong public market returns, we started to see positive effects for private equity, and that should continue over the next few quarters as they catch up to the public markets. For the 1-year period, the return of 13.14 on page 12 was 31 basis points behind the policy benchmark. It's roughly evenly distributed between the allocation effect and the management effect. The management effect, again, is private equity and a few others. The allocation effect, we've talked about this almost every month. This will start rolling off. We were at a high level of cash at the beginning of the period. We've taken cash down to a very low level. So cash was a drag, but on the positive side, the underweight to tips in Core Plus 5 and the overweight to REITs helped as REITs outperformed, as Seema will show you in just a couple of moments. And 3 years has a similar result. Important page on page 16 shows how FIRE did versus other large public funds, and this page defined as public funds greater than $1 billion. This page was prepared when the returns were preliminary, so the returns are off by a few basis points versus the actual numbers that you see earlier. So for instance, the one-year return of 1310 is slightly different than just a few basis points off of the return on the earlier page, but that placed you just above the median. And the good news is 3- and 4-year returns versus your peers place you in the top third, and for 4 years, now you're in the top quartile. If you go out for a few other years, you're also above median. So unless there are questions, I'm going to turn over to Seema for discussion on equities.
Thanks, Martin. So if you turn to page 21, this shows you your domestic equity allocation. So about $2.9 billion after management's 34% of the total fund. And I'll just point you to a couple columns that we talk about, the index return, the actual return, and then the difference column. As Martin mentioned earlier, you saw more strength in mid-cap and small-cap U.S. equities versus large-cap, and that's shown by, if you just look at the index return for small-cap, up 1.85% in the quarter, mid-cap, as defined by the S&P 400, up 3.6%, and then the Russell 1000, which is your large-cap, and even the Russell 3000, which is predominantly large-cap, up about 10 basis points to 25 basis points. But overall, your U.S. equity has outperformed by nearly 100 basis points in Q4. Fiscal year to date is slightly trailing the 12-month. So good numbers for U.S. equities. If you turn then to page 28, so we'll go through your international allocation. And as you can see there, it's about $1.4 billion in total dollars, 16% of the total fund. And here in this case, compared with the U.S., different from the U.S., your international equities are much more active than they are passive. And again, if you look at the index return, the actual return, the difference columns, as Martin also mentioned earlier, EFA had a very strong quarter, up about 6.5%. And emerging markets also did well, up about 5.6%. Both of those stronger than all of the U.S. equities in the quarter. And, you know, just in the difference column, I might just point out this one number under active emerging markets. It's, you know, behind the benchmark for the quarter. It's just one quarter. Over longer periods, this manager has done well for you, so I wouldn't be too alarmed. If you then turn to page 29, some more detail on EFA. So $790 million in EFA, 9% of the total fund. And you might remember that we finished our EFA search toward the end of last year, and we funded the new managers just a few months ago. So we would expect and hope to see that performance kick in with the new lineup of managers over the coming months. So you can see in the trailing 3 months, a bit behind the index. So the purple bar is the FIRE portfolio, and the yellow bar being the index. Similarly, in the fiscal year to date, a little bit behind a benchmark, and then trailing 12 months a little bit ahead. But again, once we see the new lineup of managers kick in, I would expect some of those numbers to improve. So if you turn to page 34, it's emerging markets. And for FIRE, about $570 million, about 7% of the total funds. And again, as you might remember, we finished the emerging market search earlier last year, and we saw some good performance from the new lineup specifically, which is good. In the quarter, though, as you see, the purple bar being the FIRE portfolio and the index being yellow, a bit behind in the quarter. Similarly, fiscal year to date, a little bit behind in the 12-month number, but again, I'm expecting to see good numbers coming out of our new lineup. So if you look to page 36, lastly here we have the hedge fund numbers. About $200 million now and 2% of total funds, making our way up to the allocation of 5%. And again, you know, it's early days, but you can see here that the FIRE portfolio is the blue bar, The other two are the two benchmarks that we're using, and we're seeing really good performance so far. And the nice thing is, you look in the trailing 12-month number, which is our full year 2012, really nice outperformance versus the two benchmarks. And we did that with low beta, which is exactly what we wanted to do. So far so good on the hedge fund portfolio. Now I'm going to turn it back to Mark.
Turn to page 38. You'll see that pie chart, and you'll see that a third of the fund, nearly $3 billion, is invested in fixed income. On the pie chart, blue on the right predominates, and that's the core investment grade fixed income program. A breakdown of the core investment grade fixed income program is shown on the following page, and it's nearly 20% of the program. In the under and overweight column, you'll see that we're underweight treasuries and overweight spread product, and we have been for some time. In the difference column, you'll see that each of the sectors outperformed. 9 of the 11 traditional managers outperformed for the quarter, similar for the year, and the ones that didn't outperform were very, very close to the benchmark. So it's been a very successful program, as you'll see on the following page. The returns. While I can't compete with equity returns and fixed income, for the quarter it was actually a successful quarter, 70 basis points, more than doubling the benchmark return. And fiscal year to date, well ahead of the benchmark, and returning 3.21% halfway through. The one-year return was very strong at 685, well ahead of the 541 benchmark. And you'll see over 8% returns for 3 years, and modestly ahead of the benchmark as we expected for the longer term as well. Next page is page 41, the TIPS portfolio. Managers in total have modestly outperformed for all periods. For the quarter, it was about 0.75%, 2 basis points ahead. Fiscal year to date, just under 3%, and 6.99 for the one-year period. And you'll see the 3-year period as 8.95. And I want to repeat, I mentioned this from time to time. We did not have 9% inflation over 3 years. So the reason the TIPS did well is because there's 2 components to the return. There's the inflation return component. If there's surprise inflation, we will be compensated in this portfolio. But there's also the duration. Interest rates, real interest rates in this case, have gone down. In fact, have gone negative, and that has benefited the portfolio. High yield is on page, or enhanced yield as we call it, is on page 42. And for the quarter, you'll see the return was very close to the benchmark. The return for the program is in blue. The benchmark, the primary benchmark, is in yellow, returning 3% for the quarter, and a very strong fiscal year to date return of over 7%, just halfway through the fiscal year. And the one-year number, while behind the benchmark, returned 13.5%. For high yield. There's been a very strong rally in high yield. The shorter-term numbers are behind the benchmark, except for the quarter. And as you know, we made a manager change in the program, so we should and we expect to go back to the longer-term excess returns that you see. And I do want to point out that the 10-year number is just shy of 10%, so high yield has returned nearly 10% over 10 years annualized. It's been a very strong asset class. Convertible bonds is on page 43, and you'll note that convertible bonds is sensitive to the equity markets. So you'll have, it's a hybrid of fixed income and equities. The return was 183 behind the benchmark, and you notice consistently that we have been behind the yellow bar. And as you know, we are taking steps to improve the program, and I'll talk about that in the executive session. And then we have opportunistic fixed income on page 44. Some of the older funds are rolling off or have rolled off, and new funds are beginning to predominate the program, as you'll see going forward. For the quarter, it was 179. Some of these numbers are, like private equity, are trailing numbers, so some of these numbers are actually built on September numbers. But over the longer run, say the one-year number, 1632, that 4% number for the benchmark in yellow is a typo. It should be 10%. But nevertheless, it was the 1632 is ahead of what our expectations are, and the 3-year number as well. the 1184 is within what we expect from this program, and that also includes some of the older legacy managers that we had. The newer managers as a whole have been doing well, but they haven't called out all the capital. And that's why it's 1% of total funds, even though we're about 2/3 of the way committed. And I'm going to pass it over to Kathy Martino to discuss ETIs.
Good morning. Your ETI portfolio continues to be a stable performer and it outperformed its custom benchmark for the quarter. And loyalties and for all the longer periods. You turn to the book, this book, whatever we're calling it today, page 6. I'll give you a few highlights on collateral benefits. Did make some new commitments in the multifamily investment program, 3 new commitments for the Bronx and Manhattan and Brooklyn, and you purchased 1 loan in Manhattan. And then if you turn to page 10.
We're in the larger book.
I held it up in this book. Yeah.
10.
We're now on page 10. Moving quickly. I just wanted to bring to your attention that the page 9, that the AFL-CIO Housing Investment Trust made an investment in the Elecchester Housing Complex in Queens at $49 million. It's a 38-building complex of buildings that were built about 50 years ago for the electrical workers. And it was all, the rehab will take care of needed improvements and utilize union labor. Are there any questions? Carol?
Okay, good morning, everybody. The real estate markets are continuing to improve, and that has been reflected in your portfolio. For the quarter ending 9/30, the fire portfolio generated a 3.6% gross return, which translated to a 3.0% net return, outperforming the benchmark of 20 basis points. And that's the new, sorry.
Where are you?
I am on page 16. I apologize. And that's the new benchmark of the Odyssey Plus 100 net. The most recent vintages are having a significant impact on the portfolio, the most recent deals that we've done, and have been very accretive to the portfolio. At the same time, the older vintages, 2007, 2008, which really took significant hits during the downfall, are starting to recover and therefore bolstering the performance. Currently, at the end of the quarter, you had 37 funds with 27 managers. Since that time, one of the funds has completely liquidated itself, so we're down to 36, but subsequent to the third quarter, 3 commitments were approved to 3 managers with a total fire allocation of $36 million. And while it looks on its face, according to the information you'll see in pages 17 through 19, that you look fully committed, we continue to look at the portfolio as things roll off and therefore always have room. And your allocation of 5% is close. We're about 80% based on our internal calculations, and we will continue to bring you best-in-class investments to keep moving the portfolio up and keep on the same trajectory that you were on certainly over the last year. The portfolio for the last year outperformed the benchmark by 300 basis points. So we look to continue that progress. James.
Morning. I'll be walking you through your private equity report for the quarter ending September 30th, 2012, and that begins on page 25 of your large agenda package. So since inception through September 30th, the program has committed $1.2 billion to 129 distinct partnership investments spread across 85 GPs. Your market value, or dollars in the ground, was approximately $560 million, representing 6.5% of total planned assets within your target range. your unfunded commitments stood at approximately $408 million, resulting in a total exposure of about $965 million. The program is performing well, slightly up from the prior quarter, generating a 1.3 times net total value multiple, 9.9% net IRR. And if you'll move to the next page, we'll continue to look at your performance versus various benchmarks. So if you'll focus your attention on the bar chart on the upper left, you'll see your returns first versus two dollar-rated public equivalent benchmarks, the Russell 3000 plus 300 basis points and the Russell 3000 plus 500 basis points. The reason for both is because you might recall that in the fourth quarter, the system changed their private equity benchmark to the Russell 3000 plus 300, and since this report's as of 9:30, we wanted to leave both benchmarks on there, but the plus 500 will be rolling off. And then the two columns to the far right of the chart are there to show how your portfolio is performing versus the U.S. private equity industry, and you'll see that your returns are performing very nicely versus the median return of the U.S. private equity industry, well over 600 basis points above the median returns, and slightly below the upper quartile returns of the U.S. private equity industry. The bottom two tables will give you a better sense of the portfolio's diversification, and the key takeaway is that, as of now, it's predominantly a North American buyout-centric portfolio. We're going to skip ahead. If you go to page 37, you'll see a snapshot of your recent commitments. So I'll give you a second to get there. And on the top of the page, you'll see that during the third quarter, you closed on one new re-up commitment to Trilantic Capital Partners 5 in the amount of $10 million. However, subsequent to quarter end, your commitments did pick up with an additional $84.2 million committed to 4 GPs, a mix of re-ups and new relationships. If you'll please turn with me to page 40, we'll look at the program's performance by strategy. So if you will draw your attention to the bottom half of the page, you'll notice that your top performing strategies continue to be large buyout, generating a 27.1% net IRR, followed by secondaries generating a 22% net IRR, and both growth equity and special situations hovering around 16%. And I will make my last remarks on page 45, where we'll look a little deeper at the program's cash flows. So a couple of takeaways here. If you look at the far right of the chart, the most recent 3 quarters, you'll see that your net distributions have been trending higher over the past 3 quarters. And this is great news. And this is also a function of a maturing portfolio. I think also important to look at is the line, which represent net cash flows. And this quarter specifically, your net distributions outpaced contributions. So more cash coming in than going out. I think also important to note we expect this trend to continue in the fourth quarter as well. So that's it for my prepared remarks. Thank you. Thank you.
Any questions on the quarter? Should we stay in the session, do the other quarterly stuff?
So, it's up to the board, I guess, we could probably do the January and then the fixed, because we have to do a separate meeting, Chair, for the 2 VSF, so I think it would make sense maybe just to do the January and do the fixed income, and then if that works for you, Doug, and then do the VSF quarterlies?
Sure.
All right, so everybody pick up your January book. It's in color. Martin always has extras if you need them. Anybody need one? So let's start on page 32. So January was a very good month. We hit $8.9 billion. We continued in February, so now we're north of $9 billion. All good. The reason for this increase, we can find on page 39. Everybody came back from Christmas vacation and was happy. Happy means, if you look on page 39, the top group of numbers meant that the U.S. stock market was up 5 to 7%. EFA emerging markets were also up 5%. That meant it was risk on, so the Treasury market was down about 2%. High yield was up, and REITs were up. Glimpsing into the following month on page 40, the halo effect kind of carried over a little bit into February with basically the U.S. market up 1%, the international market's down 1%, Treasuries up 1%, and again, the high yield market continued to keep going. March is up, just to give you a glimpse as well. So I think we're actually in a very, very good spot market-wise. If you look at how we're set up, you can go to page 35. We haven't changed asset allocation at all. We're set up leaning into U.S. equities. We're over-allocated U.S. equities. We're under-allocated 4+5 in tips. We're going to talk about the ranges for 4+5 in tips in a little bit. And we're a little over-allocated to high yield, all of which are the right place to be at the right time. If you look at page 41, the far left-hand column, so we're up about 3% for the month, 5% for the 3 months, and fiscal year to date up 9.5%. Since February was up, we're probably up about 10%, and March is also up, so we're probably up 11% through March, so 9 months in, up 11%, I think we're in a good place. All of our markets are making money, so it's a little bit too good to be true, but it is all true. Any questions? Okay, so that's January. We have to go to the VSS now for the quarterly?
Yes.
Yes?
You should have gone to the VSS.
Yeah.
So,
So we need a motion to move out of public session, close the meeting, right?
Actually, you know what, let's, I'm sorry, before we go out, let's just take care of one piece of business, okay?
I can't hear you.
I said, let's take care of one piece of business before we do that.
Okay.
Mark, you want to talk about the tweaking of the asset allocation bands?
Right, you saw that in the, so I'll refer to what Larry went through on page 35 of the monthly report in color. You'll see that where you've been underweight the core plus 5, and because of the market movements, strong equity market movements, we went below the 4.5%, under the rebalancing range on the low side for core plus 5. TIPS is plus or minus 2%, and so a similar thing happened with TIPS. NEPC has a write-up on page 115 in the large agenda package. And I'll let Doug speak as well, but logic here is thus. We don't feel that moving money into core plus 5 and TIPS at this moment, considering the fact that we have, it's important to look at also page 34. 34 is the raw numbers without the adjustments. So if you look at page 34, at core plus 5, we're actually modestly underweight, well within the rebalancing range. And when you look at page 37, I believe it is, in this book, there are 3 different parking places for core plus 5, including uninvested, 50% uninvested opportunistic fixed income, 50% uninvested real estate, and 50% uninvested hedge funds. So as we invest hedge funds, which are coming up, as we invest real estate, as you know, is coming up, and as we invest opportunistic fixed income, which we are getting drawdowns, all things being equal, which are never equal, but all things being equal, the situation will take care of itself, because what happens is, as, turn again to, I think it's page 36, a lot of numbers on this page, but if you focus in the middle of the page where it says total core plus 5, if you look under the actual column, we're at 18.4%. The policy target is 19.5, so we're modestly underweight. But the adjustment column, because of the parking places, adds another 3.7%. Those parking places adjustments, as we invest more in hedge funds, as we invest more in opportunistic, and as we invest more in real estate, and we expect all three of those to be, to have investments coming up over the next few months, that adjustment will go down. So all by itself, the allocation, all things being equal, will go back within policy. But to address the policy, to address the fact that there's the adjustment factor for Core Plus 5, we're requesting, and NAPC has rationale as well on page 115, to move the 4.5% policy for Core Plus 5 to plus or minus 5%. Similarly, for tips, from 2 to 2.5%. And the rationale there is that twofold. We increase the allocation, number one, to tips from 3 to 5%. And secondly, as Doug talked about, the expected return going forward for tips is very, very modest. When I say modest, it's very modest, very low. So with that, I'll turn it over to Doug.
Yeah, great. So when we look at this, the transition going on in the portfolio, again, going back to the color monthly book, comparing page 34 and 35, again, the difference is that with 34, you look at where you're allocated relative to your policy weights, your long-term objective. And you can see that in the pink, the opportunistic fixed income, you're underweight 3.5. The hedge funds in orange, you're underweight 2.4. And then the smaller underweighting to private real estate green in the middle at 1.4. All those have formulaic reallocations to get to page 35. And when you look at page 35, you can see that part of the underweighting to fixed income and tips is essentially allocated with a slight overweight to enhanced yield, which we think is a good trade-off for being underweight the opportunistic fixed income. And then you have 1.5% in cash, where you effectively are planning for the call downs from the opportunistic fixed income managers, call downs from any real estate managers, and any funding of hedge fund managers.
I also do want to let the board know that we're trying to run cash at the absolute minimum.
Right. So we agreed upon a 0 to 5% range for cash to give you flexibility. And what we're recommending here is essentially to broaden the two fixed income categories by 0.5% so that you have a little bit more flexibility long term as you manage this transition. I mean, overall, we're very comfortable with it. And I pointed out some of the other reasoning is when you think about the history of the policy index, we bumped up tips from 3 to 5 as a target weighting. I don't think we ever got to 5, but tips have been doing so well that you've been trimming back those in certain points in time. The tips portfolio, the tips asset class has outperformed core nominal bonds by 3% a year for the last 3 years, even though inflation has been sub 3%. So they've definitely gotten a little bit rich. So that's why we're comfortable with expanding the band by 0.5% so that you don't have to rebalance.
It's not just rich, but I'll repeat my earlier comment. There are negative real yields and tips going out past 10 years.
That's right. And in this environment, they're also acting more like nominal bonds when rates rise.
What that means is, unless there's surprise inflation, you're guaranteed to lose money if you invest in tips.
That's right.
Could I ask a question, though? Isn't it true that tips or performance is driven by expected inflation, especially the long ones, more so than actual inflation?
It is. It is. The tips move in different environments when the market is worried about either central bank or action or economic conditions that they think may lead to inflation. And it really the tips have been more volatile than nominal bonds in terms of the ebbs and flows of that sentiment.
So it seems, if we thought that maybe Fed policy was a big wild card, that's one of the best, insurance policies out there to hedge against.
Yeah, and that's why we increased the long-term target from 3 to 5. And again, this recommendation is just about giving you the flexibility to manage the rest of this transition where you're ramping up these less liquid asset classes.
Thanks. So we need a motion, I guess, to take take any of DC's recommendation to expand both of those ranges.
So moved.
Is there a second?
Second.
Any objections? Hearing none, the motion passes.
Thank you. Now we can adjourn the pension fund public session and move to the BSF public session.
We need a motion.
So moved.
A second? Second. Any objections? Hearing none, the motion.
I was just waiting for the others. Okay. If you turn to page 3, you'll see that for the firefighters, BSF, as of December 31st, the market value was $388 million. And on the left, you'll see that the return for the quarter was 144 versus the policy of 153. Fiscal year to date was strong on an absolute basis as well as 12 months, but was slightly behind the policy benchmark. 3 years was very strong and slightly ahead. And as I pointed out for the other systems, for the 10-year number, it's 8.01%, so 8% for 10 years ending December 31st. On page 4, we have the asset allocation, which is much simpler than the larger fund, primarily because of the need for liquidity for the annual payments. And the largest allocation is U.S. equity, shown in green. The only comment that I have for this is that after the payment was made on December 15th, you see that there's 3% cash. What happens is we get an estimate for what the payment's going to be on December 15th. We raise it, and any excess that you see here, which is 3.1%, was moved back. So I believe it was done in early February, was moved back into the asset allocation. The attribution for the fund is shown in the next few pages. And I do want to get into the overall fund, unless you have questions on the attribution. The fund is, like I said, a simpler asset allocation. On page 11, you see the total equity, which is the policy 70%, we're just below that. And by far, the largest piece of that is the domestic equity, Russell 3000, and that is on page 12. It's 100% passively invested, and it's just short of 50% of the entire fund, so it's a very important part of the fund. And as expected, as you look at the blue bars, which are your returns versus the Russell 3000, which is the benchmark, it's within a few basis points as expected from the passive portfolio. The EFA markets, developed markets, non-US, on page 13, is a little more volatile because it's active, as would be expected. So for the quarter, it was strong at, on an absolute basis, 568 behind benchmark, and strong on fiscal year to date at 1252, also behind the benchmark. The one-year number was also strong. It was ahead of the benchmark at 1765. And again, 10 years, ironically, was also 8.01% for EFA. Page 14 is emerging markets, which is 4% of the fund. And the return was well ahead of the benchmark, just shy of 8%, over 200 basis points ahead. Fiscal year to date was spot on with the benchmark of 1395, and the 1 year was very strong, 1812, but was behind by 50 basis points. We have a 5-year record, which is negative because of the time frame. REITs has a 3% policy, and that's managed by Morgan Stanley on page 15. And as you see, they've done very, very well. REITs had a very good year in 2012, and on top of that, Morgan Stanley beats benchmark. For fixed income on page 17, 2/3 of the portfolio, of the fixed income portfolio, is invested in the 4+5, and the policy is 30%. We were slightly overweight at 31%. Page 18 is the breakdown, and as you see in the difference column, each of the 3 sectors outperformed. Putting it together on page 19, the return was 76 basis points, more than doubling the policy benchmark, the custom benchmark. Fiscal year to date was 317, also well ahead of the benchmark. And the 1 year was very strong at 645, also well ahead of the benchmark. The longer term numbers are as we expect, but on an absolute basis for core fixed income has done very well. And it is 20% of the fund, very similar to the fire. TIPS is 3% of the program, and that's shown on page 20. This is managed by PIPCO, and PIPCO has nicely outperformed the benchmark for the one-year period and the fiscal year to date, and for the quarter was ahead by 15 basis points, returning 84 basis points. High yield, we changed managers for the program. There's a single manager, it's now T. Rowe Price. They outperformed slightly for the quarter, the first quarter that they're on performance. And for the 1 year, we're underperforming, and longer term, for the 5 and 7 year numbers, they're strong on an absolute basis and slightly ahead of the benchmark. At 10 years, almost spot on, 9 basis points behind, returning 885. That's what I have, unless there are questions.
No question? Okay, then we need a motion to adjourn the firefighter variable supplement meeting.
So moved.
Second.
Any objections? Hearing none, motion passes. We'll start the fire officers variable supplement meeting. We need a roll call, trustees. Yes.
Roll call.
Pardon?
Need to do a roll call.
Yes, we need a roll call.
Ms. Janice Emery?
Here.
Mr. Larry Laws?
Present.
Mr. James McGowan?
President.
Mr. John Dunn?
Here.
So I have 4 votes, we can start the meeting.
We have extra copies of the quarterly report.
You have a way of reviewing the report and we accept it as written. Thank you.
Thank you.
Thank you.
All right, that's pretty short. So we now,
I
we need a motion to move into executive
No, you
session.
have to close the.
Oh, sorry. You need a motion to close the fire officers variable supplement meeting.
So moved.
Second.
Any objections? Hearing none, motion passes. We need a motion to move into executive session.
So moved.
Second?
Second.
Any objections? None? So we're now in executive session.